Welcome everyone to another episode of OTA on the air. And we are welcoming back a return guest who helped us out earlier on during the start of the pandemic to talk about what the economic impact was potentially going to be going forward. And happy to have him back again now to kind of give a better perspective of what has happened and what we can expect. So as I did last time, I'm just going to hand the controls over to Alan with the American Trucking Association and have him give us what their economic impact is and what they see are going to be happening here in the next 6 months to a year. So Alan, go ahead and take it off.
Great. Thanks again for having me on. I do have a lot of information here, about 30 to 40 minutes worth. So if there's questions at the end, I'm also going to leave some time. I know it's a lot of data, a lot of numbers. So if you're not a numbers person, I'm going to try and break it down as easily as I can, but definitely ask me lots of questions. A lot of this stuff might not be as straightforward as I'm making it seem. So without further ado, we'll just jump in real quick before I get into the economic data, talk a little bit about the number of COVID cases in the US and how that compares to the cases in the European Union. As you've probably seen on the news, cases are surging and surging like they haven't been at any other point previously. And why I'm mentioning that is because it's leading to a lot of shutdowns. So you're seeing a lot of shutdowns on the West Coast, East Coast. You might be seeing some states changing their rules, changing their gathering sizes, and that's going to continue to affect the amount of output the United States produces. It's going to particularly impact the services side, so less of a concern on the trucking side. But if you like watching football, I was disappointed to see Ohio State's game get canceled last weekend, but looking forward to watching the game this weekend. Glad those rules got changed there for them. All right, jumping into that output kind of indicator that I talked about just a second ago. So this is quarterly real gross domestic product growth. This is kind of your overall growth in the United States. These are annualized rates. So we're thinking about, hey, if this continued this growth pattern that it did this quarter at an annualized pace. So 2018, 2019, pretty steady growth, a little bit of a dip at the end of 2018, but nothing like what we saw this year. So 2020, end of March, COVID really started impacting the economy. Places shut down fast, and second half of March was largely shut down. And that's the end of the first quarter. Second quarter, again, COVID, down negative 31.4%. Huge bounce back in the third quarter, but did not make up for everything that was lost in the first half of the year. And what we're looking at for the fourth quarter, right now our estimates are at about 3.7% growth in the fourth quarter, 2.7% growth in the first quarter. But these things can change. So they're circled there because we just got a lot of data this week. So this is actually a great time for me to do this presentation because I have a lot of data that's been updated through November rather than a month ago, so a little bit more current data. But the fourth quarter, that might end up getting revised down a little bit because we're starting to see some less than optimistic employment figures come out. Retail sales were not very hot in November, so that 3.7% in the fourth quarter might be a little bit stronger than reality, but we'll see going forward. 2.7%. I think that's actually a little optimistic for the first quarter of 2021, just because of some of the data that we've seen right now. And there's still a lot of discussion about this stimulus package. If we can get a stimulus package through, if we can provide some increased unemployment benefits, provide stimulus checks like we did back in April. I guess those checks kind of went through April through the summer. But if we can get that passed, then these optimistic figures are a little bit more promising, but they seem to still be held up at the moment. A lot of talk today, if they haven't reached an agreement already, but I haven't heard anything yet. Rest of 2021, not incredible growth. We don't have a lot of reasons to see a lot of growth here. A lot of the figures that I'm going to go through are starting to level off. This is on a quarter. This is the same thing, but on a year-over-year basis. So this quarter compared with the previous quarter, Second quarter of this year was down 9%. Third quarter also down. Fourth quarter, we expect that to be down compared with the year earlier. When I go back to the previous slide, these are annualized rates again, so it's not comparing with the previous year. This is just assuming the same pace of growth, and you're going to see growth coming out of how far we fell in the first half of the year. So this is year over year, which gives a little bit better perspective of what we're looking at this year compared with last year. So even though we're growing, it's not growing at a great pace compared with the year earlier. I think this is probably the best representation of this. This is in the actual dollar value. This is billions of 2012 dollars. And we're not looking at pre-recession levels until the first quarter of 2022. And that's going to be largely on the good side. I actually think my next slide might, all right, a couple slides from now, that's actually more on the good side of the economy, the services side of the economy. We might not expect to see that come back until 2023. But here you see that V-ish shaped recovery. We were talking about V, W, check mark. So it's a little bit of that V, but a long recovery after that initial bounce back in the third quarter. So K-shaped recovery, that's our new letter. We haven't seen really anything like this. It's just because of the split between the sectors of the economy. So e-commerce is doing great. Retail overall is doing great, starting to be a little bit sluggish now. Home improvements doing well, home construction, grocery stores doing well, and trucking benefits from all of those sectors there. On the other side, you're seeing the opposite, see these other things head in the opposite direction: travel, entertainment, services, restaurants. While we see them recovering, they're still not going to return to those levels we saw in January or February for a few more years here. So non-residential construction also struggling. Factory output, we actually saw a pretty promising figure in November, but still down compared to where we were before the recession. And energy is struggling considerably due to these low oil prices because of this collapse in demand for gasoline and other fuel. All right, here's that slide I was mentioning. So consumption of goods came back very strong in the third quarter, above where it was in the first quarter of this year. That's the blue line. Consumption of services is the orange line. Did not come back to where it was in the first quarter of this year by the third quarter. Not expecting it to come back by the fourth quarter or even the first quarter of 2021. It's got a much longer recovery there. All right, employment trends. So on the left here is monthly employment changes. So these are your month-to-month changes, and all these numbers are in millions. And on the right is the overall non-farm number of payrolls. So really good recovery as far if you're looking at these employment changes from month to month. The latest data we have is for November, and that was an addition of 245,000 jobs. It was a lot lower than expectations, but 245,000 jobs on a month-to-month basis is huge. For a little bit of perspective, the average for all of 2019, average month-to-month change was 198,000, and that was 245,000. Still taking that into consideration and looking at the graph on the right, we have a long ways to go to get back to the levels that we were seeing in January and February as far as this total employment. If we continue, so we're down, I think, we're down about 9.8 million jobs from where we were in November. And so if we continue at this pace of about 245,000 jobs each month, it's going to take over 3 years, about three and a third years to get back to the levels we were in February. So really strong month-to-month gains, but even at this pace, it's going to take a while to bring these jobs back. Another employment figure is the number of unemployed. So this is November of 2019, 5.8 million people unemployed. Sounds like a large number. November 2020, 10.7 million people unemployed. So these unemployment benefits are going to be huge in stimulating the economy and making sure the economy maintains a growth economy. Another factor underneath all this is the labor force participation rate. So we saw a lot of people leave the labor force, and a lot of that's on a lot of women are leaving the labor force. So you see these couple circles here. These are the two lowest levels in participation rate for women since 1987. So these the number of, so when we're thinking about the labor force and thinking about the unemployment rate, which I have not mentioned, when people leave the labor force, that gets taken out of the unemployment rate. So the unemployment rate looks stronger than it is because of these people who are leaving the labor force. And that's largely because of this daycare issue, right? And I think this graph shows that a lot of women are leaving the labor force because they're more likely to look after their children when they're not working and they can't find daycares. So just another underlying problem going through the economy. All right, retail sales. I mentioned a little bit of sluggishness in November, and you see that at the very end there, you see that dip. It's about 1.1%. So it did fall from the previous month. Previous month fell about 0.1%, so about zero. So you're starting to see some sluggishness in October and November, indicating we want a little bit more stimulus. We want those stimulus checks. You heard the Fed Chairman Jerome Powell talk yesterday about this need for the stimulus checks or more unemployment benefits. Still, I mean, it's really still a high level, which is great to see. You see sluggishness, but it's a high level. It's still up 4% compared to a year earlier. So good signs there, but it's not all even throughout this retail sector. Here's a nice table, I think, showing where all this growth is. So in the orange, we have total retail sales excluding online sales, and then in the green, we have online sales or e-commerce. So we had been already seeing really strong growth, both on overall retail sales and especially on online sales, 12%, 9%, 12%. Then 2020, we see online sales surge year to date, 21.4%. That's through November. In November alone was up 29.3%. We expect that growth to continue into into December. But you do see that overall retail sales, excluding online sales, was actually down 3% year to date this year. I mean, a lot of that was due to this severe drop you see in March, April, and May, and it's still only up about 0.4% in November when you take out that online sales. So a huge shift in where people are spending their money. A similar shift we saw change this year was grocery store sales and restaurant sales. The blue line is grocery store sales and the red line is restaurant sales. Up until about 2015, grocery store sales were above restaurant sales, but you saw that shift and start to separate considerably going into 2020. But then you see the restaurants close due to the spread of COVID. As a result, more people are spending money on groceries at grocery stores, and you see that continue to through the rest of 2020. We start to see it come back a little bit as the number of COVID cases decreased and there was more reopenings, but now we've seen that rise, as I showed you on my first slide. In November, actually saw a pretty good jump in grocery store sales and a decline in restaurant sales. And partially that's probably due to this colder weather, limited capacity within stores due to the rise of cases, but still a trend that we're seeing. All right, we're in the holiday season, so we have to talk about holiday sales. We expect holiday sales to be up around 5% this year over 2019, but as it says here, there's going to be winners and losers, right? So winners are going to include e-commerce, just like I explained the 2 slides ago. Building materials are going to be strong, sporting goods, warehousing, superstores, furniture. You guys can read them. They're up on the slide. E-commerce sales as a percentage of total holiday sales are expected to hit an all-time high this year, up at about 25%, compared with up from 21% in 2019 and 11% from a decade earlier. So really a considerable shift in how people are spending their money. They're not spending money at department stores, clothing stores, restaurants, electronics, and appliance stores. Other drivers of freight, let's talk about housing here. So the housing starts continue to do very well after the dip. So we saw really strong housing starts at the beginning of this year. Actually, end of last year, December was really strong. January, February. A lot of that was because of this mild winter weather, and we're starting to see that now again. But a really good, strong comeback in housing starts. I know, and existing home sales also looking very strong. You might look at these slides and think, hey, is there going to be another big bubble? Is this increases like what we saw a decade ago, more than a decade ago, really? But if I were to bring this slide out more, this starts at 2011. If I brought it all the way back to 2003, 2004, 2005, you'll see that we're only nearing the levels that we were there. 2005 housing starts at an annualized rate. Sorry, I should have specified that at the beginning. Annualized rate. So if that month had been spread out through the year, that's what we're talking about here. The annualized rate for housing starts was above 2 million, and it's still only around 1.6 million here. And existing home sales was up above 7 million back in 2005. So still demand is outstripping supply. More people want to buy houses than there are houses available. So we expect this area to continue to be strong, especially as mortgage rates continue to be low and are expected to be low until employment returns to a higher level like what we saw in January and February, and the inflation rate comes up to around 2%. Another driver of freight, manufacturing sector. So what's going on in the manufacturing industry? We look at this factory output index from the Federal Reserve. Really strong bounce back, good month-to-month growth. There was a little bit of stagnation there in the summer, but it's continued to come back, but still clearly well below where it was earlier this year before COVID. Not a driver of freight, but an indicator that we look at is this inventory to sales ratio. Really, it's just the level of inventories. And this data is adjusted for seasonal effects, holidays, trading day differences, number of months in a year. Just like all the other data that I just went through, it's all seasonally adjusted. And this data, however, is lagged 1 month, so it's through October. We've seen inventory levels fall considerably, well below what we've seen in the last really 5-10 years, especially on the retail side. Retail side's dropped, it's at an all-time low. So we expect to see a lot more restocking activity, which could fuel some more trucking growth just because of how far this retail level of inventory has fallen. All right, moving on to the industry demand. Let me just check my time here. All right. Right on track. So industry demand, the spot market has really outperformed the contract freight through this year. Contract freight is good for some sectors, but it's really hurting on some other sectors, and the seasonality is off considerably. So what used to be a good month is now a bad month, or not as strong of a month. So when we use these seasonal adjustments, it exaggerates a little bit. So you'll see in the next couple slides that I'm going to use a 3-month moving average to ease out that up and down, that fluctuation, volatility. That's really mostly there because of that seasonality. So it's a good peak season for dry van and temperature controlled carriers. As expected, we see e-commerce doing really well. We see grocery store sales doing really well. And LTL freight's actually even recovered nicely. So they do have a major component. A major part of LTL freight is manufactured goods, which is still below where we were earlier this year, but we've seen a nice bounce back there. And we are also seeing that a lot of these LTL carriers are taking over some of that e-commerce. After this peak expected growth in freight, we expect that growth in freight to level off. So we saw that huge surge come back. But kind of just like the employment figures that are reaching kind of it's leveling off. I mean, there's just not enough demand there left to keep increasing at that same pace that we came out of that recession. As I mentioned a slide ago, that restocking effect is expected to continue through 2021, the first quarter of 2021, because you just see how far inventory levels have fallen, especially relative to sales. So a lot of potential growth there. So bottom line, freight is good now, but you can expect freight growth to moderate after the first quarter of 2021. The levels expected to remain high. It's just the growth that's coming down a bit. All right, so here are those charts I mentioned. So on the left, you have for-hire truckload contract loads index on a 3-month moving average, and this is considering millions of loads, and I'll talk about revenue in a bit, but billions of dollars in revenue, so a lot of robust data here. We saw a good bounce back, so it didn't dip too far like you see in the spot market, as you'd expect with the contract. Our contract loads index you're not going to see as much volatility there, but you're starting to see some sluggishness now, and these are seasonally adjusted, so a lot of that seasonality is considered, but that 3-month moving average helps take that out. Spot market loads on the right there, huge comeback, but again, starting to see some sluggishness in growth. And where does that occur? So dry van, as I mentioned, temperature controlled, doing well. So this is for October. Yeah, I should also mention this is through October here. November stuff we'll have out at the end of this month. Year to date, also doing pretty well on dry van and temperature controlled. Flatbed and tank, truck, and intermodal are all struggling though. Tankers rely a lot on the energy market struggling quite a bit. Flatbed housing market's doing well on the residential side. So how residential housing is doing well, construction, I mean, on the residential side is not doing well. Non-residential side is struggling. Residential side is doing well. Non-residential side is not doing well. And manufacturing is coming back, but it's still below where it was a year ago. Intermodal, it's going to rely a lot on trade, right? So as you see these surges across the globe, surges in cases across COVID cases across the globe, intermodal is going to be depressed there. Okay, LTL markets. This is also a 3-month moving average through October, and this is tonnage. So you see that dip as you'd expect in the first half of this year, April, May, but a pretty good bounce back through the summer. But you start to see that growth level off. Still pretty high levels considering. This is not our data, but we get this data from US Bank, and it does a nice job of breaking out where we see strength by region. So you can see Northeast, Southeast, West, National, Southwest, and Midwest. Shipments in green and spending in blue. Not going to spend a lot of time on that, but I'm going to sit here for a bit just so you can see the difference in regions. You see Northeast, shipments a little bit lower, lockdown a lot longer, had a lot more cases, keeping that controlled. This is for the third quarter, so we might see a bit of a change in the fourth quarter as we saw a lot of these surges in cases spread to the West and the Midwest. But still, overall, pretty good growth in the third quarter over the second quarter. All right, here's year over year. So this is quarter to quarter. As expected, we'd expect all these quarters to be up from the second quarter to the third quarter, except maybe the Southwest. I guess that makes a little bit more sense because they didn't shut down a whole lot of things in the second quarter. They didn't start to shut down until the third quarter. But this is year over year. This is year over year percent change. The same data, US Bank. But now this is shipments for the third quarter and year to date. So these are year over year figures. So as you'd expect, even though we see a lot of growth in the third quarter, that's compared with the second quarter. If we look at a year earlier, down in just about every region here. This is the same thing as the previous slide, but instead of shipments, it's spending. So year over year, you have third quarter in gray, year to date in green by region. This is same slide as 2 slides ago, but you can see more of trends. So this is from 2015 to 2020. National in red, west in orange, southwest in gray, southeast in yellow, northeast in blue, and midwest in green. So you saw pretty strong bounce backs in the southeast and the west. Not quite as strong in the midwest and the northeast, but and you can see the change year over year a little bit better here than the previous slides, and how they'd been operating in previous years. And this is through the third quarter. And same thing except with spend instead of shipments. So clearly good bounce backs in spend, except maybe the Midwest, not quite as strong as your other regions, but still interesting to look at. And I think it largely has to do with how each region is mitigating the spread of COVID. As it says there at the bottom, it does include truckload and less than truckload. All right, moving on to industry supply. We're coming in on close to 30 minutes here, so I do want to leave some time for questions. So that's why I didn't spend a lot of time on those slides. But if you have questions, I'm happy to go back to them. All right, so industry supply. Bob and myself have been talking about this underappreciated storyline of this tight capacity. I think it's a little more appreciated now. I think it's more clear now, but we've been talking about it since the summer and what we're going to see on the other side of the recession. It's very likely that a lot of fleets went out of business without a whole lot of acknowledgement for a couple of reasons. One, COVID-19, and two, liability insurance renewals. We do, in our data, that we're already seeing that for-hire fleets are operating fewer trucks than a year ago. Equipment orders are up, but sales are going to come in at or below replacement rates. On top of all that, not only is there fewer equipment out on the road, equipment available, but there's fewer drivers. The Drug and Alcohol Clearinghouse is reducing driver counts year to date as of November 1st. 38,000 drivers are in prohibited status, with another 29,600 of those not starting the return to duty process. So reducing driver counts there. On top of that, you have the pipeline of new drivers going to be a little bit weaker. It's going to be hard to train drivers when you're dealing with these social distancing procedures, restrictions on when things are open, when things are not open. It's a much tougher process to train drivers at this point through a pandemic. Yeah, and as we're in here, it's a pretty deep hole, and it's going to take some time to dig ourselves out of, just like what you saw with the overall employment. Even if we're bringing in 250,000 new employees every year, it's still going to take 3+ years to get back to where we were in February. So bottom line, there's more capacity that has left than people really understand or really appreciate. And that's going to affect rates. It's going to affect your transportation costs. It's going to affect profit lines, right? All right, so this is exactly what I mentioned before, what we're seeing in our data. Truckload and LTL power unit fleet trends. These are year-over-year percent changes. So compared with the year earlier, both on the truckload and less than truckload side, we're seeing 4 to 5% fewer trucks being operated than a year ago through October. And you see that trend all through the pandemic there from February, or from April through, or really March through October there. Here's for-hire carrier power unit fleet trends, year-over-year percentage changes, broken down between large truckload carriers and small truckload carriers. Large truckload carriers did not see much of a change, but on the small truckload carrier side, you actually saw a pretty considerable change. October down 5.4%, year to date down 2.8%. So I was talking about employment throughout this entire presentation. I think that's the major storyline here. For-hire trucking employment, this is in millions. This is including truckload and LTL. Now, this is not just drivers. This is including your mechanics, your sales, anyone involved in this trucking employment sector. So still clearly down considerably from where we were in February. It's coming back, but it's clearly gonna take some time, and you can see that it's coming back at a faster rate than it had been before, but still a long ways to go there. Labor competition is fierce. These are industry employment trends through October. On the left there, you have jobs lost during March and April. That's the blue and the green on the left. And then on the right, you have the jobs gained since March. And this is comparing for-hire trucking and construction. So in for-hire trucking, we lost 96.7 thousand jobs, 96,700 jobs. Construction lost just over 1 million jobs in March and April. That compared with the previous month, that was a 6.3% drop in trucking, a 14.3% drop in construction. And the jobs gained since May, this is through November, for-hire trucking has added 43.8 thousand jobs, and construction has added 804,000 jobs. So as in the text there, that's about 45% recuperation in trucking, and construction recuperated about 74% of those lost jobs. So still clearly some ways to go, both on the for-hire trucking side and the construction side. And this is not just drivers, this is everyone involved in each of these industries. All right, we did talk about equipment sales. So equipment sales have been up the last few months, but if we're looking at 2020 as a whole, you have Class 8 truck sales in green and trailer production in blue. 2020 as a whole, we expect to be down about 37% compared with 2019 on the Class 8 truck sales side, and trailer production forecast to be down about 42% year over year. So really strong sales the last few months. However, considering how much these sales came to a halt in the first half of this year, second quarter of this year, really, that's why we're seeing these huge year-over-year deficits. So when you have capacity as low as it is and demand coming back faster than capacity can keep up with, you see some rises in rates. Dry van up 4.6%. This is in October also. I know I keep jumping between October and November. Our data, we only have through October until the end of the month. And a lot of data just came out this week on the government side. So October dry van up 4.6%, flatbed up 2%, temperature controlled up 2%, tank still down 2.9%. There's still a pretty low demand in the energy market. It is coming back, but well below 10-15% below where it was a year earlier. So tank revenue per mile, excluding fuel charges, down 2.9%. The spot market, this is an actual rate, 29.3%, and LTL revenue per mile excluding fuel charge is 1.6%. So as you'd expect, just as with any other good or any other industry, when demand is above, when there's more demand for transportation than there is supply available, then it's in the carrier's hand, and rates can increase from there. In a quick driver shortage update, we do have some new numbers for the third quarter of turnover. Third quarter, we saw turnover increase kind of as you would expect. Large truckload carriers up to 92%, small truckload carriers 74%, even LTL saw a 14% turnover rate. Reason why we would expect that is because of how strong demand came back. So second quarter, huge drought in demand. Third quarter, we see that demand come back. These drivers are jumping from carrier to carrier, trying to find the best deals that they can find, and so you start to see that turnover rise. Generally, we see turnover rise when demand is high. And no real update on the driver shortage. We didn't do a new driver shortage analysis this year, but this is what we had before, and we're we're still sticking with what we have forecasted from that year. 2020 is going to look a little funky. We don't have that line displayed on this graph. We saw that driver shortage go away when demand fell quite a bit in April, May. But we think it's really worse than ever now and expect it to continue for a few of those reasons I mentioned a few slides ago, talking about the amount of supply, capacity in the industry, the number of drivers, that driver pipeline, and the number of trucks on the road, number of trucks being operated by both truckload and LTL carriers. And with that, I can take any questions and I'll hand it back.
Great, Alan. Thank you. Thank you so much. Again, for those online, if you would have any questions for Alan, please throw it in the Q&A or the chat and I can ask those. But let me start off with, are you seeing on the driver shortage piece, are you seeing any impacts or any impacts of the unemployment compensation funds being supplemented, having an impact on the available drivers, as well as those who I guess may have been furloughed, not coming back to the industry, or is it too early to tell?
Yeah, I mean, we hear stories, and I'm certainly not going to be one to say that, hey, these unemployment benefits are keeping people from coming back into the industry. But I also think that it's not just these unemployment benefits that are keeping people from working, right? It's also health concerns, family concerns, childcare concerns. There's a myriad of other factors that are impacting it. And as a whole, we don't have the data yet to really break that down and find studies to see why people aren't jumping back into the labor force when we see that there's clearly a demand for drivers and there's clearly a lot of people who are unemployed. I think another part of that is also the training aspect. You can't just jump into a cab and be ready to go, right? There's that training aspect. There's that pipeline of drivers that want to jump back into the industry. And I know we are hearing a lot about some drivers who are retiring and saying, hey, that's it. And those are folks that are not going to come back into the industry. I mean, I suppose it is possible. You did see some nurses and doctors come back into the industry after retirement to help out the hospitals, especially earlier this year. I'm sure there's still folks doing that now as many hospitals are reaching capacity. But it's definitely a factor, but the data as a whole in normal times shows that that these increased benefits to those who are unemployed generally does not keep people out of the labor force. But that is normal times, and things are certainly different now. And I do want to go back to that. There's other factors, health factors, safety factors, and childcare, as we see with the labor force participation rates, and see that diversion between men and women there.
All right. Well, I've got no questions in the queue at all. So you've done an amazing job of bringing us up to date on where we are today, and look forward to continually looking at this as we move forward into Q1 and Q2. So Alan, thank you so much. And thank you for those tuning in.
Great. Thanks for having me. My email's there if you guys were just too shy to ask questions this time, but glad to be here. Good luck to Ohio State this weekend.
Great. Thank you all.